Hello, YouTube. This weekend, we're going to go through a bearish scenario, a bullish scenario, and understand that the stage is set and we have more than 3 decades or 30 years of history, which tell us a bearish story. And then the seasonality chart, which looks at 20 years of history, tells us a little bit of a bullish story. So stay tuned. I think we have a great show for you this weekend. What we're going to talk about is basically going to be the current arrow we're looking at here and the current arrow we're looking at here, where this led to a 20% drop. It was actually 25 to go all the way down to the low. And we could potentially get a 10% cut if we lose our key support area at 43.76 on SPX, which basically means move lower, dead cat bounce, and then the final move lower. Crash landing on strong support or our 50 moving average, which would also happen to basically correspond here with our 200-day moving average. That's a pretty strong support area. And with a bearish pattern starting to emerge, we have to be mindful of it. So at a very high level, that is how we could go 1, 2, 3, 4. And the fourth one's the worst one. So we get 1, 2, 3, 4. If the fourth one's going to be the worst one, it pretty much has to be negative 10%. Why does this matter? Well, because that's how we get down here to negative 10 at 41.76, or that drop I just mentioned. Although, if we are going to get a bullish story, which we've not seen so far this year, where we go up into the beginning of September and then down, that's not happened. But usually Santa Claus comes to town starting in October, where we go up, 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 up. So what is that scenario? Tell me really fast in about 30 seconds. Here you go. It basically comes down to whether or not number 4 and number 5 play out. The arrow's pointing to the two months of consolidation. You can clearly see that here by the 2 red candles, 2 red, 2 red. We have an inside bar. So if that inside bar holds, meaning the low holds, we have an inside bar. And then also we go to number 5 or print a new high like we did here in 2020. And like we're looking to do here into 2023, that would lead to the bullish scenario. That would lead to us not only rallying into September, but October, November, and December, putting in yet new highs. And because the market is here at neutral or roughly 50%, I don't think the one team really has an edge. We want to keep in mind that 5 or 10% corrections are normal. But when we look here to our graph, it shows us that we've already had a 10% cut so far this year, which is right here. That's 9%, 10%. And so far this year, we've already had 5. So that's a 9% cut, a 5% cut. And it tells us that maybe we've already had our 2. If we're going to go for a third one, maybe we do. But it's normal to say that, which works out to more than 1 per year. So is this time normal? Is this market normal? Are we going to do what we normally do every year? Are we going to do what we've done on average over the last 30 years? It depends on how we look at the data. Let's try to understand a little bit more because there are some really big events happening this week. Reality is creeping in on the NASDAQ's year-long dream, right? Dream rally. Okay, NASDAQ 100 drops as Apple and NVIDIA see second worst falls. This is really important because Apple's event comes in on the 12th, and this is going to be on Tuesday at 10 a.m. Pacific. Why? Well, look, Apple's down by 6%. NVIDIA's down by 8.4%. A little bit later in the show, we're going to look at these charts to see exactly what those tell us. But let's get a little bit more context. Why? Because the NASDAQ is doing something that is defying rates. It is defying gravity. This just does not normally happen. The red line is going to be the NASDAQ 100, and the black line is the 10-year note. They have an inverse relationship, which means that when the black line goes up, red line goes down. You can see that happening during this period here, also during the period where we actually have the move lower, ultimately go higher. It goes up, this goes down. It goes up, this goes down. However, now they're both going up together. This is extremely unusual, which means one of them's wrong. The 10-year note's either going to come down or the market's going to come down. It's one or the other. Here's a really good way of thinking about it. Numbers like that informed this week's loudest warning, a study by Face Factor investing legend Mark Arnott that labeled NVIDIA a great company priced beyond perfection. Beyond perfection is a pretty big word. Take a look at the big 5 platforms: Apple, Amazon, Meta, Alphabet, Microsoft. Why? Look at the graph here. If chips lead tech and tech lead SPY, the Magnificent 5 revenue and profit versus GDP growth doesn't look all that great. Big 5 profit, way down. They're negative. Look at the Big 5 revenue, right back down here to basically close to 0. What does that mean? There's some numbers here we can look at. It tells us that their collective net income fell to 263 in the past 4 quarters, down 9% from 289 from a year before. That's what it tells us. It tells us that we should be going lower. And here's the final problem. The final problem is that more than 80% of funds that reported since June are overweight Amazon, Microsoft, and NVIDIA, which means there is a very top-heavy weighting to these stocks. Have a look here and just look, right? Apple, NVIDIA, this is the last 1 week. If we look out to the last 1 month, it doesn't look all that bad. We want to be extremely mindful of this. We also want to be mindful that looking at the last 3 months, Apple is basically flat, Nvidia's up, Microsoft's looking basically flat too, up by about 3. This matters because on Friday, September 15th, we're going to be having quad witching. Why does quad witching matter? I don't have the number for this current quarter, but this time last year, $3.2 trillion were up for grabs. That's a lot. And the last report for June 16th had $4.2 trillion up for grabs. That is also a lot of money. I'm going to ask you for a huge favor, please and thank you. If you could please consider smashing that thumbs up and subscribing to the channel, I would really, really, really appreciate it. Thank you for your support ahead of time. Let's move forward. This also really matters because we got CPI coming in on Wednesday. So Apple on Tuesday and then CPI on Wednesday. Those are the two really big events for me this week. Look at these numbers, 0.2 to 0.6. That's a triple from where we were before. Looking at CPI year over year, going from 3.2 to 3.6. I want you to pay attention to one thing here. Looking at the last 1 month, or basically since the last report, energy's been doing pretty good. I don't know about you. I've been noticing the prices at the pump going up. Why does this matter? Well, because this is the graph we're looking at here. This is year over year CPI, where every time it comes in with an actual that is red, 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 which means misses, which is good for stocks. So if we get 3.6, whether it's green or red, I'm not sure. But I think that if we're seeing a trend of reacceleration going to 3 to 3.2, back up to 3.6, here's where it gets a little bit scary. I shared this, I don't know how long ago on Twitter. If you want to follow me, the link's in the description. That's my handle. It shows us here going back to August 28th. And this is CPI from the 60s to the 80s, comparing to the 2010s to 2020s. Look, we go straight up, we go straight down, and then maybe we see a reacceleration. It doesn't have to be perfect. But this trend, if we get another one, again, a trend starts when we have 3 data points. That would be our low. This would be a higher high. And then we would have yet another higher high. This still shows us that maybe we have another year, maybe a year and a bit more before we actually maybe do repeat the up move. But this gets me a little bit concerned. It gets me concerned at a time when, technically speaking, which we will review a little bit later here, we have CPI coming in on the 13th. And then we have the Fed coming in on the 20th, so which means that for the next 3 weeks, we're going to have 3 candles. So if we do fall below this area and we do start to repeat this move, I'm not going to be hoping and praying where we're going to repeat the seasonality chart. Again, please stay tuned. We will go through those in a moment here. I will make sure I follow up on that. The Fed is getting more hopeful it can avoid a U.S. recession. Hope is great, but it is not an investment strategy. Sorry. I'm looking here to GDP and understanding what the Fed is looking at. 5.5 is an extremely high number. What concerns me is that every time we get really high, like above 3, 3.5, we go right back down to 0. Get above 3, right back down to 0. Get to 5, right back down to 0 in short order. Get to 6, right down to 0. Get to 3, right back down to 1. So a recession is 2 quarters of contraction. This 5 print right here might be very bad for stocks. However, it could also be what I mentioned before, where it's 2007. Looking back to here, we raised rates for a year and a half, almost I think it's about a year and a half. Then we hold rates flat for 1 year. So when the Fed thinks they're getting hopeful, they can avoid this. They're set to what? Hold policy rates steady later this month, just like the Bank of Canada did this week. What would that mean? We're going to get our pause. Pauses are bullish. Pivots are bearish. So pivots happen because something is usually breaking. So let me see if I can pull up that thing really fast. Our largest declines happen in a bear market, happen after pivot. I'm going to try to pull that up. But anyways, when we look at here, what it shows us is that here, actually, I got it. So let's pull this up. Here we go. Open a new image, open image, a new tab. I want to talk about this because it shows us here that the Fed pivots. We go down 36, we go down 48, we go down 27, we go down 50, and we go down 58. Those are pretty big numbers. That would get me a little bit concerned. So if the Fed is going to be pausing, bullish, if they pivot, the recession's right here. You can see that the gray area identifies the recession. They cut, recession. They start cutting, recession. They start cutting, recession. They start cutting, recession. They cut, recession. They cut, recession. That's the exact same thing we just looked at here. Just showing it to you in a different format. 1970s, 80s, 90s, 2000s, 2010s. Is it time for the 2020s? Maybe it is. We've not yet had one. All right, so if we're going to get a pause, this could be bullish for potentially 1 more year, just like that CPI print we showed you. From July of 2006 to July of 2007, we don't go anywhere. We hold flat. If that happens here, we could have another year of delay. But It doesn't mean we have to avoid this drop. We could not. And again, please stay tuned. We'll go through that in a moment here. So wrapping this all up together, there are some reasons to be optimistic too. The economy is entering September with strong momentum. Fed is only slightly restrictive, so we don't expect an imminent recession. Imminent being the keyword there. Imminent meaning tomorrow. 10-year rates at current levels are similar to the old normal regime. All right, so we understand all of this information. Now tell me a simple story, because you've been talking a lot about a bear scenario, a bullish scenario. Now just make it really simple for me. All right, here we go. So the 13th of September is going to be very important, and then also the 20th of September. Let's go through two scenarios here. So what we've talked about lately is the inside bar break. So just like here on S&P, where we were calling for a correction, going back to this most recent move, what happens? Well, a dead cat bounce into an inside bar. What does that mean? Well, it means the direction of that break is likely the short-term trend. We have yet one more inside bar. So if we get a bullish break, it means we're probably going back to that seasonality chart. We're going to be back above our 452 area, or back above this Fibonacci area. And that would be constructive. That would be bullish. But if we lose it, the short-term trend might be down. And the reason why that matters is because our bullish pattern here on the monthly relies on one thing and one thing only. Let's go back to SPX to make sure it's very simple. Why? Well, because it means we have to hold the low. So if we don't hold the low, that is how we go into the crash. So with 3 weeks left, that is a really long time in this market. So here's the scenario. If the short-term trend is going to be established by the direction of this break, if it's a bearish break, we could have 1, 2, 3 weeks of downside where we go down, 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 all the way down to our 50 moving average for that 10% cut, like we alluded to in the title of the video. So that's how I can see us breaking the pattern. If this monthly low holds at 433, it could be bullish. We have to wait for October to confirm. There's a lot of data this week. So if this ends up being a positive or negative catalyst, we're going to be looking for that follow through. One more time, let's make this extremely simple. After SPX loses this area, what happens? It just goes down, down, down. We go down, dead cat bounce, 1, 2, 3 weeks in a row. We go down, dead cat bounce, 1, 2, 3, 4 weeks in a row. Down, dead cat bounce, and then we got another 1 or 2 in a row here. What would that mean? We'd be looking for that same thing. Down, dead cat bounce, and then maybe 3 to 4 red weeks in a row, which gets us to where? Right to the end of September. That's that's a pretty big coincidence. So let's look at a few more quick charts, because we've been talking about the short-term momentum on the daily chart. As a reminder, the daily chart has 5 daily candles to form 1 weekly candle, and 4 weekly candles forms 1 monthly candle. So if we want to understand the health of this long-term chart and the higher time frame chart, we want to look down to the daily chart to see what is actually happening here. And this is not a perfect pattern, right? It might be a head and shoulders. It might be an inverse head and shoulders. It might be a cup with a handle. But by being below the short-term price or the 50 MA for 3 days in a row, it's not a really good sign for me. Now we're going to go through some stocks in order to see exactly how soft they are. So S&P is now below for 3 days. That could be the start of a trend change. We talked about this before. The same thing happened when we started the decline. So if we're going to start a decline like we did at the top, a couple days below, that's the start of the bear. It's the same thing for that period we just looked at. 1, 2, 3 days below, man, it just starts fading, fading, fading. So being below the blue line is not good. If it's below both, it's terrible. So if we understand that, and we understand that chips lead tech and tech lead SPY, we want to be mindful this week. Why? S&P is now down for 3 days below that moving average. We're going to look here really close, and we're going to note that the NASDAQ is not yet below. 1 day below on Thursday, back above on Friday. This could be a trap. We want to be mindful of that. Let's go to mindful of that. If we go to full candles, we notice the same story here. If we look at SMH or chips, 2 dadays below, it's starting to give us that same trend, those same warnings we just talked about. We look at NVIDIA, not yet below. It's actually got a back test of the 50 MA, and it's holding for now. This would be one of the things I'm looking for to confirm we're going to be going for that move lower. I don't really care what the news is. I just care that we lose the short-term price. Why? Because the long-term price is basically at the gap fill, and it's $150 lower. That's a pretty nasty cut if it happens. Looking here to Apple, Apple did not fill the first gap. It did not fill the second gap. It has now spent multiple days below, meaning 3, and it is also back below its 2022 high at 182.94. So being back below the red line, it's not good. It's not good at all. Tesla spending multiple days below and at risk of losing its uptrend, but there is going to be a Tesla event, if not this week, the next week, where they're expected to reveal their Cybertruck and other things. I don't know. Is Tesla going to drag the market higher? Drop me a comment and tell me what you think. I'm looking to FXI or China. Man, this is terrible. They've been spending a lot of days below one, two, three, four, but 5 out of 6 as well. With a G20 summit and China not present, this does not look good. Moving forward to Microsoft. Microsoft now has 1 day back above, but it's also below its 2022 high. I don't think Microsoft being over is enough. It's got to rally by roughly 1% more to make it to 338. Let's see if it can actually drag some of those other stocks higher like Apple. ARK couldn't quite test the 50. Momentum is not catching a bid. Bounce off the 200 and unsure what it's going to do with the 50 here. Looking to the DAX, it is below for multiple days now, right? Dead cat bounce, hit it, reject. Okay, so that's Germany. Now we look at Canada, 3 days below, right? Not looking good, below both averages as well. We look to emerging markets, it is way below. So it's not just S&P, it's not just chips, it's a lot of things. It's sectors, it's countries. Japan is doing okay here, but man, that's been a big change. So Japan's holding up, QQQ is holding up, Ether is not, Bitcoin is not. So there's a lot of really soft charts here. We want to be extremely mindful of what that could mean. One more time, when the S&P is the best game in town, it does not mean it has to go lower. It just means there's drag. So if you look at that heat map one more time, when Apple had its news regarding the thing happening in China, what happened? Well, NVIDIA tanked. It dragged Tesla down. That's called sympathy. It's called it dragged other stocks down. Look at all of technology here. It's all red. It's all bloody. So when the rest of the world is showing us some warning signs that they're looking to go down, we don't want to ignore that. We want to make sure we're aware that if we crash land on the long-term price at about 415, that's about a 10% drop from the high. So if we go from here all the way back down to the 200 DMA or the black line, that should be a dip you want to buy. You should be excited for the opportunity to get a discount. The problem is most people don't see stocks declining as a discount. They see it as a bad thing. So with that said, if you want to join us for 14 free days to see exactly how I take all this plan and formulate it into a strategy to try to make money, which I've been doing a pretty good job of lately, go to thealgo.com to trade with me, Justin from YouTube, and claim your 14-day free trial. If not, I encourage you to watch the video now queued up here on the left-hand side, which talks about last weekend's prep and exactly how we thought we would get here. So if we were accurate going into this week, maybe we're going to be accurate going forward. Thank you so much for tuning in. I really, really, really appreciate your support. Thanks so much.